Our next guest says that there are signs of weakness that are quietly creeping into the markets that feel like a series of paper cuts. And that's a pretty good description of what we've seen so far. Joining us to elaborate is Liz Young. She's the head of investment strategy at SoFi. And yeah, paper cuts can hurt, right, Liz?
They can once they get to be a lot at a time. And so far it's been pretty orderly, but it's happening under the surface. So things that are obvious are the VIX has climbed quite a bit over the last month or so. Still under 20.
I was going to say still under 20, which is not historic. Like if you're into trouble periods, that's,
right.
That's
it was
not really
it was hovering
flashing.
Between 13 and 14 for a long time. Now we're at 18, right? So it's not troublesome yet. But then you look at things like the 50-day moving average rolling over on the S&P 500. The number of S&P members still trading above their 200-day is down to 40%. Not crisis levels,
Industrial's
but
a lot
down.
weaker.
Industrial's a lot weaker. During crisis periods or big pullbacks, you usually see that down to 11%, even 3% in COVID. And then things like the relative strength index, which tells us whether or not things are oversold. Doesn't scream oversold yet, but certainly the number of members that are showing as oversold has increased quite a bit, from 5% to 22%.
There's a lot of money in the sidelines, and in part that's because you can make a lot of money by parking in a money market or something. You get 5% or north of that. Those people, those investors are kind of waiting to say, if there's a pullback, do I actually jump in? We're not in correction territory yet. You're close to it.
Yeah.
And maybe people are starting to think, okay, is this the pullback I've been waiting for? What would you tell them?
Well, I mean, that's really the biggest question, right? Is it a head fake? We're down about 7% since that local high at the end of July. I don't think we're washed out yet. I think there's much further to go, especially if yields continue to rise, especially on the long end of the curve. And what we've seen happen with the curve recently is a re-steepening, and that's usually what inflicts pain on stocks. So at these levels and all the metrics that I just mentioned, I think there's probably more of a risk to the downside still. I don't think that this is an entry period. But to your point, you're getting paid to wait, right? There's really no rush to get in at these levels. You get paid 5% to sit in treasuries or in money markets, so why not just wait it out and get a decent return in the meantime?
And I guess people will say, what's the catalyst? And what we've been pointing to the last couple of days or last couple of weeks is earnings season's coming up again. What do you expect to hear from those companies? What would you need to hear to say, okay, I feel better about this?
Yeah, well, even with this recent pullback, I still think stocks are priced for a pretty strong earnings season in Q4 and into 2024, expecting about 9% growth year over year in 2024. That seems high to me. If you're expecting margins to continue expanding somehow without cutting a bunch of costs, I just don't think the math quite jives yet. So I think there could be a catalyst in earnings season, but we're not really going to hear a lot of that until about 3-4 weeks from now. You've got inflation data still coming out. We've got the Fed on pause for October just because of the way the calendar works. But there's a lot of economic data that could come out between now and then. I do think that if we start to hear earnings revisions downward for 2024, or if we start to hear companies come out and make it less optimistic that they're going to hit those targets in 2024, that's where you get a deeper correction to multiples.